Namaskar. Hello and welcome to P Guru's channel. I'm your host Sri Iyer. Today is Sunday. A look at the markets last week, next week. How is the overall economy headed? To know all of these, let's welcome our co-host Sridhar Chityalaji. Sridharji, Namaskar and welcome to P Guru's channel.
Namaskar, good morning, good afternoon, or good evening to all of you. Once again, we'll just make an opening statement. We are giving you what we believe to be macroeconomic and market parameters as we observe and giving a market analysis. This is not a broker dealer channel. We are not giving you any stock tips or index advisors. You can make your own observations or speak with your financial advisors and make the appropriate decisions. Just want to make that very clear upfront. Over to you, Sriji.
Thank you so much, sir. And a shout out to all of you who are logging in to like this video so that it has the best chance of going viral. Sridharji, the Dow has been doing well last week. I'm just going to put up the chart here, sir, in a minute.
Yeah.
And as the Dow keeps marching on, basically because maybe good numbers and also perhaps that Fed has said that it is going to decrease the rate of increase or it is going to decrease the quantum of increase, whatever it is. And do you think that the run-up is going to continue? If not, why not, sir?
Well, I think we'll give the response in two phases, in two passes. First, we'll address the market. I think the market has risen. I mean, we have been saying this. There has been excellent numbers, earning numbers. Remember, this is the third quarter economic data, not the fourth quarter, but the third quarter economic data. The numbers have been very positive. We have been across the retailer sales, retailer revenues and sales. And we have also seen across the Dow as well as the S&P, what we call as the old economy. That is, those which are being long-standing companies which operate normal businesses rather than the tech type of a model. They have performed well. So therefore, you have seen that Dow move up. Dow had 150 points up. And then that cascaded into a positive into the both European and Asian markets on the back of also a falling dollar. So now the question, therefore, is it a sustainable momentum? The response to that is we will show some data, what the market analysts are predicting in terms of what the forward 20 years would look like relative to what the past 20 years look like as the economy rebalances. The answer, if you can hold on, we will answer to that question as we look ahead at the future. But it's very clearly that the Dow, the S&P, the big boy here is NASDAQ, which has gone down from about 17,000 to 11,000. We got a separate section later in the program. We'll address that. We'll show you at the chart how NASDAQ has performed relative to S&P. Now that felt itself in the European markets. You saw the uptick in the DAX, the FTSE, and the CAC, which are the German and the British as well as the French markets. And then it also cascaded into Nikkei. The day it was down purely because of the continuing inflation issue that Japan is facing on the Nikkei side. The Shanghai went up because the Shanghai seems to be, it is very difficult to predict the Chinese market. Hang Seng went down, the Shanghai went up on the back of the Chinese issues around the COVID situation. That's broadly the equity summary in terms. I think we can see in my overall there should be some positive momentum as a result of the rate of increase slowing down. That's the statement coming from Fed. The rate of increase will slow down to accommodate the economy and slipping it from further contraction.
So viewers, stay tuned. We are going to discuss two things. One is NASDAQ and the other is the tech boom over? That's a very, very important segment because India is $400 billion industry that is reliant on high tech. And there may be some correction headed your way also. So stay tuned for this program. Next, sir, let's take a look at bonds. Some mixed value. The US 10-year has gone down to 3.691. Not long ago, it was skirting 4.0. So take it away, sir.
Well, I think that you are absolutely correct, Sriji. As you rightly point out, We have shown in our program that over the last 3-4 weeks, we have even seen 4.1% on the 10-year handle. It has now come to 3.7. This is the long handle, which is what we call as the 10-year. 10, 7, and 5 are still showing the slowdown of the rate of the future rates that these yields are generating. The reason being that the Fed statement, the Fed minutes that got released last week also indicated that we're going to see the rate of increase being slowed down because they are seeing better inflation numbers, better CPI, which is the consumer price index, better PPI, which is the purchaser price index, which is the wholesale price index. So what they're seeing is that there is a deacceleration in the inflation curve. Hence, they will not accelerate as they originally contemplated. They will allow the economy to normalize. And that is always felt in the 10-year. So all the three, which is the US 10-year, the bond, the Japanese, and also you would see which we have shown here is the British 10-year is also tapered down. So I think these are all positive numbers just on the inflation as well as the long-term rates are concerned.
And now let's look at the foreign currencies. And we are again seeing the euro drop, same as the British pound. Tejati, what is the underlying reason for this?
Inflation goes up, US dollar goes up, money goes towards the US dollar, shifting away. And so therefore, we talked about this last weekend. So the dollar appreciates. Now, when you have the inflation numbers coming down, the US dollar value decreases, whereas it gives the uptick to the other currencies. So euro is now around 1.039. It's almost 1.04. Remember, it was around 1.0506 before this economic kind of collapse started. And then we had it even went to 99 cents, which we covered in DGI, euro to US dollar. So there is positive movement in other currencies as a result of a falling dollar on the back of very positive inflation numbers.
And now let's take a look at crude. Crude is falling, and we talked about this, I think, in the middle of the week also. Sridharji, the falling crude should also help in inflation. Thereby, I'm thinking that the US dollar will again start depreciating versus euro and pound, sir?
Exactly. I think you basically hit the nail, which is effectively to say that they're reducing dollar prices. This is the future. Remember, I always say that the oil trades in future. So the West Texas is around 76. Remember, this was around 84. So it has come down almost by 10% in the last month or so. So it's very positive. So 76.55. It'll take some time for us to feel the positiveness in the gas gas stations for some more time, but then who knows? Let's say Brent has come down to less than $84. Remember, this was 95, so it's almost come down by about 14%, 14 to 15%. That has also cascaded its way into natural gas, so that's also coming down. So all the crude prices falling as a result of, I believe, two parameters. One, they believe that the Chinese having a problem, so there may not be a demand pressure from the Chinese side. That's one thing. The second is that there is supply coming in to the market. Where is the supply coming in? Remember, we talked about US increasing a little bit of its capacity. We're also talking about the price cap, some countries following through, and Russian oil now being purchased at the price cap. We gave you the dates, December 4th and January 19th as two specific dates. So people are kind of filling up their storage capacities and drawing the oil. But it is mostly as a result of both the inflationary tendencies as well as the supply.
I seem to have momentarily lost Sridharji. I will be able to get him back momentarily. He will rejoin. And in the meantime, could you please like, share, and subscribe to our channel, and also click on the bell button for notification. Sridharji, please continue, sir. Okay, we just lost him again. He's going to try and come back. Just hold on for a second while he comes back. By the way, this is even though this is a news channel, we urge you to go back and watch our previous segments. In other words, you have to stay in touch, listening to previous episodes, because as Sridharji was saying, there are places where we'll be referring to something that we talked about a few days ago. That continuity will be there if you keep continuing to watch our program. Thank you so much. Sridharji, over to you, sir.
Well, I think I covered, I don't know how much was missed, the oil and the West Texas and the Brent as a result of both supply as well as the people accepting the price cap, and as well as there is cutoff dates for the oil, which again we covered. So that's one basic driver. The other basic driver is that there may be demand constraints as a result of Chinese having problems. So I think that's on the energy side. Now getting to commodities.
Sir, in commodities, the gold has risen a little bit. So again, it's a hedge against inflation, or is there something else, sir?
Well, just to give a perspective, the gold started around 1850, 1850 when we started here, somewhere around 1850 to 1870. It is now at 1755. It dipped to about 1630. When it dipped, why did it dip to 1630? Remember, the money shifts from this commodities to US dollar whenever there is inflation and high yield coming from the investing in the dollar market, which is the bond. So now the inflationary pressure seems to be off, and the dollar 10-year dollar is around 10-year yield is around 3.8, 3.7, and so obviously the money is moving towards gold. So you have seen now an uptick in price. It's around 1755. It will finish the year probably close or at par where we started the year. That is the reason. Now, who are the big buyers of the gold? There has been a significant purchase. I think the number that I'm hearing is between July and September, close to about 600 tons of gold has been purchased. And there is an unknown buyer, which they have not been able to account for, 300. They believe that could be Chinese, and Chinese buying the gold from Russia.
Oh, wow. And our favorite topic, cryptocurrency. Take it away, sir.
Yes, our famous topic, which gets a lot of attention. We're not here, promoting crypto in terms of the Bitcoins or Ethereum, but crypto as a technology will stand the test of time, and it has stood the test of time. So just to get back where we started with Bitcoin, which is the benchmark, we started on $44,000 or $45,000, if I remember right, when we commenced this year.
Yes.
So it has had a majestic fall as it went down the hill, and it's around 16,500. It went even below 15,000 on the back of the FTX issues, FTX solvency issues. So now I think it just seems to have regained its composure, and it was up around up close to 2% higher than what was its historical low. Right now, this 16.583. There's also what you call liquidity that is being committed by people like Binance. CJ is committing at least $1 billion to give impetus or stability to the industry. So some of these factors are contributing. Let me give you another important piece of data. These things are not for conventional retail investors, who come in and trade and see they can make a buck. On the ETX, Sequoia says that it had exposure of $210 million, and it has written it down to zero. So the big boys can absorb these types of SoftBank, Sequoia. They can absorb a Temasek. They can absorb these types of big numbers because their portfolios are in billions. It's not something for the retail investors and speculating on the back of it. So that I just wanted to point out the Sequoia, which is now publicly they've reported. Look, we take risk. That's risk capital. Venture capital and private equity is risk capital. We expect one or two to hit off. We expect some of them to fall. We take a value proposition, we see, and we call, and we put money into it. So that's the crypto market, Sriji, for you.
Thank you, sir. Now let's take a look at the market thus far. How has the Nasdaq performed? How has the Dow performed? And also, how has the S&P 500 performed? Sridharji, the what are the top lines, sir? Is that Nasdaq?
The top line is Nasdaq. It started around 15 point, close to 16,000. Where is it? It's around 11,200 now. So it has had a very dramatic fall. Very dramatic fall relative to S&P. You can see S&P. S&P is around less than 5K for and around 5K, and it's now around. It's got back to about 4,000 points. So on a relative scale, if you have to take $7.4 trillion have gone off, have been written off the tech sector. Okay. So we have given these numbers close to 28, 29% is the NASDAQ fall year to date, compared to about, less than 12% for the S&P, and less than 8% or 7.2% for the for the Dow. So the Dow, the old economy, has performed. So the question, therefore, is the tech economy beginning to come to the reality? Now, I call it as the four phases of nirvana. One is euphoria. The second is disillusionment, and the third is enlightenment, and fourth is reality or integration. So I think we will soon get over this disillusionment phase and then get into the reality. So this is the same chart, I think, that is being reshown, which is the NASDAQ versus the S&P. So we can move to the next chart, G.
Okay. Sir, give me a second. I think I may have missed it. I'm going to bring it up.
Doesn't matter. We can continue the stream of the discussion. So we can go to the next section, Sriji.
Yeah. So I seem to be missing one chart, which is that of the. I think I loaded the wrong chart there. My apologies.
Doesn't matter. We'll discuss it. Yeah.
Yeah, we'll wing it. So first off, we were talking about this. This is the most important section of this talk. So viewers, pay attention, because a lot has been happening in the last few days. Suddenly, companies are not laying off hundreds; they are laying off thousands. Sridharji, how do you read this?
Well, 140,000 people between Amazon, Cisco, Twitter, Meta, they established like HP, and so on.
Google
so
too,
there's
yeah.
there is a very big set of an Alphabet, very big layoffs. Microsoft, there's very big layoffs going on. What is the reason? They point out three essential reasons. Rising costs, so which means interest rates. So it is adding a burden to the cost of capital. That's number one. The second that they are saying, demand. See, there was a peak demand in 2020 and 2021 because everybody was working from home. Everybody had to retool, and everybody assumed that is the normalization. The tech industry boys are saying, no, the reality has dawned. People are getting back. The same amount of infrastructure that is required, no longer. People are not playing video games. People are not doing a lot of entertainment stuff. So the tech consumption, both on the corporate and the retail, is coming down. So that's the second, which is the demand constraint. I think the third that they are saying is that the normalization, whenever the economy is contracting, remember the United States, which is one of the largest, and then you take about the rest of the world, United States is only going to finish 2022 at probably minus or close to 0.6% of the GDP. We don't have the last quarter estimates as yet. This is the last calendar year. The only kind of the India is, we already talked, India is going to grow their fiscal year around 7%. China is going to be less than 5%. And then most of the other economies are in that 3 to 5%. All that simply implies is that there is going to be a demand constraint coming from a contracting economy. So industries calibrate. They've seen it in 2022. That is going to flow into 2023. So as a result, you have seen the top 10, 15 tech companies, their valuation numbers fall and fall quite dramatically. Amazon is now less than $1 trillion. Microsoft, all these things have come off their historical highs. While we keep cribbing and critiquing about crypto and so on, please go back and do the analysis of these top tech companies. And some of the numbers that we are seeing is quite astronomical. Some of the guys, the top level engineers, I am told, based on this is the reporting data, used to be paid anywhere between $800 to $1.2 million by these big boys, whether it is Apple, whether it is Amazon, whether it is, I don't know, whether it is Twitter, etc. So, but they don't give you specifics, they give you the headline numbers. Those numbers have now come down to something like $180,000 to $200,000. So you can see contraction in the wallet of some of these big tech boys who are employed as senior software engineers in this industry.
Sridharji, one thing I have to tell you, I used to be shocked traveling in airplanes as to how many people were affording to travel in business class. I'm not saying anything right or wrong. I mean, I'm not jealous or anything like that, but I would expect those people to normally travel in economy because, affordability and so on and so forth. So clearly there was a serious inflation in salaries. Now, the challenge is the people will be having lesser salaries to work with and more work because probably some of the top tier, the cream may have already been sent home. Of course, they can probably be looking at something else or retire for good. Who knows? But we'll wish them all the best. And as always, thank you, Sridharji. And we'll be back on Tuesday. Possibly, we are not 100% sure. We will let you know if we are not going to be able to do it. Most likely, we will. And thank you very much once again. And do like, share, and subscribe to our channel. Don't forget to click on the bell button for notification. Namaskar, Sridharji.
Namaskar. And sir, one important observation I want to leave, and then I conclude. The observation is that the chart that Sri Iyer is missing is basically what we call a 20-year moving average of returns across three segments, equities, bonds, and a mix, which is the bond and equity chart. So historically, on a 20-year basis, the 2022 relative performance is somewhere between 6.2% and around 6.2 to 6% across these three. Now the story is that as we look at 2023 onwards in this new, which is old, which is S&P and so on, or whatever is the appropriate index that you use, we are going to see an uptick, which means the money is going back. The reason why money is going back, this probably people feel is the opportune time to enter the market. So therefore, you will see money flowing into value and core companies. And as a result, you may begin to see the uptick in the stock market. This is the second half of the question that Sri asked. Will you see an uptick in the market sustain? The answer is, based on the current indicators that we see, it seems to reflect that money is coming in from retail investors into the traditional markets, and hence we may see the uptick. So on that note, I would like to conclude and take the opportunity to thank Sri for giving me the last 85 seconds to wrap the section.
Sir, just hang on, sir. Don't go yet. I'm going to try and bring up that slide. Just 1 second, sir. Because it makes sense when we see it and talk to it. All right. Let me see if I got it right. Hopefully the cache didn't mess it up. I had everything right. The only mistake I did was that somewhere some copy paste error took place. Yes, sir.
Yes. So this blue chart, that blue graded is 2022. Long-term annualized. Long-term is not my data. This is all these wonderful people who have put together. I was able to look at this data and I said, I must share this data. So when you look at the 20 years rolling back as at 2022, if you had only invested in equities, your annualized average return would have been 4.1%. When you invest in 2023 going forward, the projection is 7.9%. So it is one of the reasons why we believe that there could be people coming into the market because the market has discounted itself to a level where there's an opportunity for the investors to come in. If you're only investing in bonds, The 20-year moving averages or 20-year annualized IRR as of 2022 was 2.6%. Remember, the reason being that we were in a low interest rate regime during considerable period of time when you factor in even 2008, 2009. Now, if you come into the bond market and if you are investing in 2023, you will still do very reasonably well at 4.6% return. Every country has a different formula, 60, 40, 60 equities, 40 bonds, 70 equities, 30 bonds, 70 equities, 70 bonds, 30. You can flip in whichever way the financial advisor. So this research team did an analysis looking at 60-40 ratio at 2022, 20 years rolling data. The annualized return was 4.3%. And the annualized return will be 7.2% if you are going to invest in 2023 in the 60-40 ratio. This answers Shree's question, is the momentum going to be sustained? The answer seems to be yes, because there is a significant amount of expansion taking place in the new economies and the emerging economies. We have already answered that question if you had attended to one of the other presentations where we talked about where the E7, there is no more G7. Historically, markets built on G7. We are now moving to E7 world. And if India is going to be, let's say, going from $3.4 trillion to $10 trillion on a nominal GDP, and China is going to be expanding at the sustained rate and bypassing United States, and United States continuing to grow at a steady state, if the money moves into those markets, then you can safely expect these types of returns to emanate. So that's the answer to Sri's question.
Thank you, sir. And while we are there, we can just take two questions that have come so far. Ramesh Kulkarni wants to know, when will the Fed pivot?
Sometime second half of next year.
And the next question is, C.A. Vishwanathan, are Indian markets in a bubble?
Shriji, only you can answer this question, Shriji. I don't think I can answer this question. You have written books on this.
Vishwanathan, come on now. You shouldn't be asking us this question. I have for long maintained that the Indian market is very shallow and it is being kept up by forces other than market. Anyway, so I will not say more. And watch my video about NDTV today. That will give you some idea of what is happening there. Thank you very much, Sridhar ji. And there's one last question. I'm so sorry about this. Darshan wants to know, why is RBI buying dollars?
RBI is buying dollars for the simple reason that when you look at all the bilateral trade arrangements that India has, most of it is in US dollars, except for ruble. Even the bilateral trade agreements that they're trying to do with some of the countries, such as the Gulf Cooperation Council, the GCC countries, is not going to be in any euro basket, but it's going to be in US dollar. Also, no, don't get me wrong. India is buying gold as well. India stocked up a little bit of gold. Is one of the buyers of the gold in the July-September quarter. They're buying dollars because there could be some opportunities for Mr. Biden to release some of his West Texas intermediary crude, so India can refine and export it on behalf of United States. So possible. So these are inside numbers which you can only forecast because, as I mentioned to you, we only give macro. We're not going to give. I'm not Sri Iyer investigative journalism. I only give market. So you want to have all this stuff that is Sri Iyer is the right person. Now, in terms of the Indian markets, then I think that the Indian market, Sriji, I don't know the depth and the level of the markets, but if India is going to grow from 3 trillion to 10 trillion, the markets have to perform, Sriji. So therefore, I can't answer the question as to whether it is the mid cap or the large cap that will perform or the small cap. But clearly something has to perform in that segment. And if not, it's not all going to be private capital or debt. But I'm not an expert on the Indian market. Sriji is. So therefore, I'll pass it back to him on the topic.
Please watch my videos on India stock markets. That's all I can say for now. A lot of India needs to grow up a lot in terms of being able to compete at the finance level of, say, London Stock Exchange or New York Stock Exchange or Nasdaq. Thank you very much, Sridharji. Namaskar.
Namaskar. Thank you so much. Have a wonderful Sunday, and we'll see you on most probably Tuesday.
Yes, sir. Tuesday.